Imagine walking into a dentist's office expecting a small bill and walking out owing $3,000 after insurance. That's exactly what happened to this husband, who hadn't been to the dentist for almost 8 years. From deep cleanings to 12 fillings, special medications, and postponed wisdom tooth removal, this dental nightmare raises a big question. Backhand index pointing right, is this normal, or is the system broken? Let's dive into the full story. Mom 68 in debt. No retirement. Sorry folks, this is a long one. Spring 2024, my uncle passed away. He and my mom, 68, inherited and co-owned my grandmother's old house. When he passed away, my finance, 32, and I, 33, bought the house for $500,000. The house was more than we could afford, but my mom didn't want to sell to strangers, so she gifted us $100K in equity from her half and walked away with $150K minus 15% in capital gains and some closing costs, so like $125K. At the time, she had taken out an $80K second on her home to pay off CC debt and get a new roof. She used her proceeds to pay it off and walked away with about $45K cash. Her primary mortgage is only $900 a month. She had about $400K in equity, and her car is going to be paid off spring 26. She gets $2,200 from SS and still works full-time, making about $32 per hour. I was very hesitant to take the gift of equity. I straight up told her I didn't want to do it more than once, but ultimately agreed to buy the house because it is what she and her late brother wanted. And as long as she paid off her car and the second and worked a small part-time job, once she retired at 70, she would be okay, or so I thought. Spring 2025, my mom gets caught in an overages scam. The initial convention is a few thousand, and they convince her to sign up for a year of Zoom meeting lessons. She signs an ironclad contract for $2,500 a month for 12 months. Note, she has been falling for scams since the 80s. She spent thousands upon thousands on real estate conventions, becoming an energy healer, publishing Amazon books, dating sites, diet programs, exercise programs, you name it. She's done it. But this time is different. She'd finally paid off her debt. With her job and collecting SS, she could save some decent money over the next couple of years. She's spending every last dime and more. Current. She's been acting panicked lately. She wants to build an ado in my backyard. Says she has no options. Our housing market is crazy, and a tiny condo in our area is $400K plus $500 HOA, so she doesn't think it's feasible to downsize. She wants to stay in town because I live very close, and she has the genetics for dementia and macular degeneration and wants to stay close to us so we can care for her when that becomes a reality. I have been feeling tremendous guilt about the equity in my house, knowing she is in such a bad spot, so I thought I would help her by building her a budget and helping her come up with a legitimate plan. She has given me full access to her banking because I have power of attorney if anything happens to her, but never look because I want to respect her autonomy. Well, I decided to look today so I could take an average of her utilities and pay stubs in order to build an accurate budget, and I found out that she opened up a second mortgage for $48,000. In September, she has withdrawn $18K of that and is holding that rest of the $30K. I have no idea what exactly for, but before that her savings were at $0. What to do? She doesn't know I know. She's my mom, and I feel responsible for her. I want to help her, but she has a problem. Part of me wants to sell my house and just give her the money back, but deep down I know she will just spend it on more scams. Is there anything I can do to help her? Should I sell my house and put the equity in an account in my name and just give her monthly payments, or is that just enabling her to continue with her bad choices? Would it be enough to even make a difference for her? TLDR, my mom has spent all her money on scams and has no real retirement plan. I have $100K in home equity that she gifted me. What do? Her primary mortgage is only $900 a month. She had about $400K in equity, and her car is going to be paid off spring 26. She gets $2,200 from SS and still works full-time, making about $32 per hour. Why in the world is she panicking about having to move or building an ADU when her mortgage is $900 per month and she makes $2,200 in Social Security and still works full-time? Well, I decided to look today so I could take an average of her utilities and pay stubs in order to build an accurate budget, and I found out that she opened up a second mortgage for $48,000 in September. Even with the new mortgage, what is her monthly cost? Can she afford it on her monthly income? And if you gift her the equity of your house, you'll have no house and her scammers will be richer. She is panicking because she took out the second. Her total now is $1,350. She hates her job and doesn't want to work forever. But if she left her job, she would have to get Medicare and her SS payments would go down to like $1,900 and she'd have $550 for utilities and food. Obviously, she can't afford to stop working and that's why she is panicking. She definitely can afford it while she works. Why did she take out a second mortgage? What did she do with the $18,000 that's already spent? And she's keeping the $30,000 in her bank account now. But how likely is it that she'll keep that as a real emergency fund and not spend it on a random scammer? And realistically, she has only $2,200 in Social Security, and it'll go down to $1,900 when she quits her job. She's going to have to work PT when she's too tired/old to work FT. Pretty sure she took out the second because she spent all her savings and maxed out all her credit cards again. Plus, I just found out earlier this week that she's fallen for a dating scam that does interviews and background checks. And I'm sure she gave them thousands, and they could steal her whole identity. I'm sure she'll spend it all. Definitely will still have to work part-time. Her crazy scams aside, I don't think she's really in that bad of a situation. It's just a matter of how far into a hole will she continue to dig herself into. All right. What's your opinion? Let me know in the comments. Moving to next post. What happens when I marry someone with an FSA if I already made HSA contributions this year? See title. My fiancé and I will marry in December. She has an FSA and I have an HSA and I have made some HSA contributions this year. Do I need to pay taxes on these or just stop contributing or what? Let's see comments. Her FSA doesn't cover you until you are married. If you are married after December 1st, then it's not a problem for your HSA contributions this year, since HSA eligibility is based on your coverage status as of the first day of each month. But she will need to opt out of the FSA next year if you want to continue making HSA contributions. Adding to this for other people's benefit, if Opie were to marry in any other month than December, they would have to prorate their contribution for the year for the number of months they were eligible based on the first of the month. If they made excess contribution, they would have to withdraw the excess. I had this same situation and recall having to call Fidelity to figure out the exact amount with gains I needed to withdraw. I believe I had to note it on my taxes in both the year I married and the year after, since that's when the 5498 form comes out. But I don't think I paid a penalty of any kind but had to report the small amount of gains. Also, it's a pain in the ass because it happens so rarely that most customer support people have no any idea what you are talking about with this. Be prepared to speak to multiple people. Or she selects a limited FSA. I don't think that's right if you're filing jointly. Married at all, regardless of filing jointly or separately. Okay, moving to the next post. Can we retire in 2 years? Wife and I are late 50s hoping to retire at 60 in 2 years. Part-time work in retirement desirable to stay active. Health. Insurance not needed from work. Current gross income $170,000. We spend $110,000 per year. Mortgage $1,200 per MO, 8 years left. Home value $600,000. Med-call area. If we retire at 60, 2 pensions totaling $110,000, little to no COLAs on them. 1 estate pension, 1 from a major national union. Currently have $600,000 in a 401k with 2 more years of $16,000 contributions, including small employer match for one of us. Each could collect $2,200 in SS at 62. If wife retires at 60 and if I'm also retired, I can't have insurance through my employer. She gets discounted family health insurance through her union until she's 65. Would be under $10,000 per year for health insurance. This is just additional stuff we don't ever expect to touch. We have substantial land assets my wife inherited. Currently, generating small income as a tree farm with harvests every 10 to 15 years. Small income. Land sales take time, but it's still an emergency backup plan. Currently minimal savings because we recently finished paying for our kids' college. New roof, small addition. $35,000. Embarrassing, I know. Also opened a $100,000 HELIC in case something catastrophic happened short term. Do not plan to touch that. Let's see comments. Yes, easily. Enjoy the extra time with your wife and family. You have health covered and pensions easily cover the remaining house payments and lost income. Take some great vacations if you want as early as possible. That's the plan. I would probably wait till age 62. Once you've got the SS, then your cash flow seems to cover expected expenses as well as surprises. Prior to that, it feels like you're cutting it a bit close. Yeah, this seems pretty tight. Is there a hurry, a reason not to wait until you have more financial padding? We do expect our expenses to drop a bit in retirement. We also hope to earn some income in retirement, but that's not guaranteed. We're thinking the 401k will take a bit of a hit for a couple of years, but one of us can collect SS at 62 and the other can wait. Once we're both collecting SS, we should have more than we need to live comfortably. Okay, moving to the next post. Husband's dental work cost after insurance is $3K. My husband has a PPO insurance, so a little better than my HMO, I think. My husband needs a deep cleaning, 12 fillings, 1 inlay. We also bought him an oral care rinse. Also paying for one other tooth, a hydroxyapatite regeneration medication for a cavity that is there but doesn't need a filling yet. After insurance, the cost we pay is $3K. He also needs wisdom teeth removed, but we maxed out insurance for this year after the fillings, so that will have to wait until next year. Is this normal? He hadn't been to the dentist in 7 to 8 years, so we agreed to the full treatment. He's not very good at brushing his teeth, so this is not surprising that he has so many cavities. Okay, let's see comments. Yes, that's pretty normal. Most dental insurance has an annual cap on benefits that means any significant work will be costly. I usually try to use a limited use FSA to cover any OOP dental expected for the next year. Yup, fillings are like $200 a pop. Don't cheap out on teeth, you always pay more. Crazy, I have a PPO and mine are $25 a pop after insurance. Sorry, yes, I meant total cost. With 12 year over year max, so 9 of those are out of pocket fully. It's bonkers how truly expensive healthcare is, including other countries. To install a CT machine can be $15 million bucks. Yes, that sounds normal-ish. Even good dental insurance typically pays no more than half, at most, for anything other than exams and cleanings, and typically has a lowish annual maximum benefit. Certainly shop around for providers, but dental work isn't cheap, and dental insurance typically doesn't pay out all that much. All right, moving to the next post. Asking a wealth manager to show their returns. Hello, I have a degree in finance and accounting, no career, so I have a primer knowledge of finance. I am in the process of finding a wealth manager. I've spoken to 2 so far, and one thing that I have asked them for is some sort of proof of their ability to generate a return. I understand they can't give me individual portfolio information, but I asked them to build a composite portfolio of their dozen most aggressive portfolios and show me a 5-year trailing return. One did not do it, and the other said he can give me a prospective portfolio. Am I asking too much? I feel like it's a reasonable ask for someone whose job is to make a return. Should I be asking something different? Thanks. Let's see comments. I work in supervision at a very, very large broker-dealer. I can tell you that no one at our firm would be permitted to generate a report like that and have it properly approved. They can generate hypothetical portfolios based on your goals/objectives, but they can't manually create one based on existing portfolios and send it out. Just throwing that out there. Okay, this is valuable. Thank you. I was under the impression that a report like this could be generated. I thought the CFA Institute created GPS specifically for this purpose. Is that not correct? That usually works for institutional portfolios where everything is more standardized. You're not going to get a composite performance of managed accounts for individuals. That is factually incorrect. GPS-compliant composites can absolutely be constructed of private client accounts. In fact, if they are fee-paying, they are required to be in a composite of like portfolios which follow the same strategy. True for discretionary portfolios following the same strategy. Issue is that within wealth management, you can have a pool of clients with wildly different strategies tailored to them specifically, especially at HNW and UHNW levels. But the bigger issue is that OP wants the advisor's performance on the accounts. This completely disregards that an advisor might have 75% of their AUM in bond ladders for retirees, while the rest are in a combination of alternative investments, third-party manager accounts, etc. for younger investors with more risk appetite. If an advisor shows the returns for the entire portfolio, it'll be closer to the bond ladder returns, and OP might think, wow, this guy sucks, because he's younger and looking for an advisor who can prove they beat the S&P. The premise of asking for performance proof is flawed, and the only way it'll be useful is if the advisor discloses information about where his clients are invested in. And that's a major no-no. All right, what is your opinion? Let me know in the comments. Hope you liked the video. See you in the next video.